Hi, we have covered mainstream valuation methods so far, right? But what happens when the textbook approaches don't work? When a company is losing money, burning cash, or on the edge of bankruptcy, what do we do? Today we are going to explore valuation under special circumstances and special situations where uncertainty is extreme. And the traditional frameworks, they need to be adapted. So let's say that you are valuing a distressed company. A distressed company is what? It is defined as one under financial difficulty, under duress. They are unable to meet their debt obligations, they are burning through cash, they are facing potential bankruptcy. So how on earth do we value this? Now, you know that traditional DCF, they become problematic because there might not be positive free cash flows to discount. The going concern assumption is questionable at that point. So instead, you typically use what is called a dual approach. You look at the liquidation value and you look at the restructured going concern value. Then you estimate the probability of each scenario. The liquidation value is straightforward but sobering. What could you realize by selling all of these assets piecemeal? Inventory at perhaps 50% of the book value, receivables at 70%, equipment at 30%, real estate at market value, and add it all up, subtract all the liabilities, including the bankruptcy costs, legal costs, etc., priority claims, and what is left for equity is often minimal. Going concern value assumes successful restructuring. You need to project a realistic path to profitability and positive cash flow. This requires hardcore judgments about which operations are viable, what cost structure is sustainable, and whether customers will stay through your distress. So what are the key variables? You look at the cash runway, how long until you run out, ability to raise emergency capital, the quality of the assets, what are the industry dynamics? Is this a company-specific problem or is it an industry-wide distress? So when you value distress situations where the equity is worthless and the debt is worth 40 cents on the dollar, let's say, the capital structure determines who gets what in different scenarios. Valuing startups in early stage companies, that's a craft. Part an art, part a science, part a negotiation. You're valuing the potential, not currently the cash flows. The traditional DCF is not useful at this point. A pre-revenue startup projecting $100 million revenue in year 5, how do you discount that with any confidence? The uncertainty is so freaking extreme that small changes in assumptions, they swing valuation by orders of magnitude. Instead, investors typically use several frameworks simultaneously. There is the venture capital method, which kind of works backward, right? And they start from expected exit value. If this company could reasonably exit at $500 million in 5 years and I need a 10x return, I should invest at $50 million post-money valuation. Adjust for dilution in future rounds and you get a pre-money valuation. Scorecard method compares your startup to typical seed stage valuations in your region and sector, then adjust based on specific factors. They look at strength of team, usually weighted at 30%, size of opportunity, let's say weighted at 25%, a product or technology, maybe 15%, competitive environment, 10%, and other factors. Comparable transaction method looks at recent seed or Series A deals for similar companies, but similar is loose here. Same sector, same state, same geography. So here's what I've learned from startup valuation. The number is less important than the structure. Are you issuing common or preferred equity? What liquidation preferences? What anti-dilution protection? A $10 million valuation with tax liquidation preferences, with 1x liquidation preferences is very different from a $10 million valuation with participating preferred. The other reality in early stages, valuation is all about supply and demand more than intrinsic value. In hot markets, valuations disconnect from fundamentals. In cold markets, great companies get funded at lower valuations. Let's talk about valuation restructuring. Restructuring valuation happens when a company is reorganizing, typically under bankruptcy protection or in an out-of-court restructuring. The concept is enterprise value versus claims value. The enterprise value is what the whole business is worth as a going concern. The claims value is the sum of all creditor and equity claims. In a healthy company, the enterprise value will exceed the claims value. There's equity value. In restructuring, often enterprise value is less than the claim's value. The company becomes or is insolvent. Valuation determines the recovery rates. If enterprise value is $300 million and the senior secured debt is $400 million, the senior lenders won't be made whole. Unsecured creditors get nothing. Equity is wiped out. This requires sophisticated analysis. You're projecting stabilized cash flows after restructuring. You're valuing on a debt-free basis, then allocating value across a capital structure based on priority. I've been involved in restructurings where we negotiated with multiple creditor classes. Each had their own valuation expert. The range of valuations was enormous, from $200 to $468 million for the same company. Why? Different assumptions about recovery, timing, sustainable margins, and exit multiples. Creditors are incentivized to argue for lower valuations, reduces what junior classes receive. Equity holders, on the other hand, they argue for higher valuations. It creates residual value for them. The court often appoints an independent valuator, but even then, it is a range, not a point. The final deal is negotiated based on leverage, not just valuation. In closing, special situations, they require adapting your valuation framework to extreme circumstances. The principles remain. Value is driven by the cash flows, risk, and the capital investments. In a final episode, we'll do everything and put it all together and think about valuation strategically and how CFOs, they can use valuation, capital allocation, and M&A decisions. I'll see you in the conclusion of this particular series, part 8. Look forward to seeing you there.